For every dollar that you earn from here on out, 75 cents is the maximum that you can spend. 15 cents is the minimum that you're going to invest, and 10 cents is the minimum that you're going to save. This is how you become wealthy. This is how you look rich. This is the fun money you get to spend, but this is where your wealth and effort is gonna go into, because the more effort you put in here, the wealthier you're gonna become. So let's play through the scenario. If you make $5,000 a month after taxes, what that means is 75% of that is $3,750 is the maximum that you can spend. $750 is the minimum of what you should be investing every month, and $500 is the minimum of what you should be saving every single month. One of the simplest hacks that you can do to help you find ways to cut back on expenses is just to put together a spreadsheet, whether it's a piece of paper or a Google sheet or an Excel sheet. You write down how much money you made and write down all of your expenses. Pull out your credit cards, your debit cards, your bank account statements, and write down every expense that you had, and then you can categorize them. That way you can see where your money is going. Because in the business world, what we say is if you can't track it, you can't optimize it. It's the same thing with your personal money. Until you actually see where your money is going, you can't actually optimize it. And what happens immediately when you track your money is you start to realize how many stupid places your money was going. Then you can turn that off very quickly, and you'll probably find subscriptions you didn't even know that you had that you can now turn off, so you can start saving money without changing your lifestyle. Then when it comes to your savings, I want you to make sure you're saving money strategically, because in the traditional Indian culture, you save money to infinity, because the way that you become wealthy, or at least what's perceived, is you just make a big salary and then you save as much money as possible, and that's it. The problem with that is your savings are losing value to inflation. So if you want to save your money strategically, you want to know how much money you should save to protect you against an emergency. And I like to say somewhere between 3 months to 12 months of your expenses you need to save. So if you are spending $5,000 a month, take $5,000 multiplied by 3, $15,000. And then take $5,000 multiplied by 12, $60,000. That's the amount of money you need to save somewhere within that range. Now you're going to say, Jaspreet, that's a huge range. And it is. And the reason why is because, well, it depends on where you are in your financial career. If you are in your early 20s, you're fresh out of college, you don't need a year's worth of savings because you can take on more risk. But if you're in your 40s, you got kids, you got parents you got to take care of, and you have a bunch more financial responsibilities, now maybe you need 6 months or 9 months or a year's worth of expenses, depending on how your risk tolerance is and depending on how stable your income is. And so depending on where you are in your financial journey, you can figure out how much money you need to save, and you can take the savings and put it in a high yield savings account. Not so you're going to build wealth, but that way at least you earn some interest on these savings. And again, these savings are there to protect you against an emergency. This is not savings you want to use as a down payment on a house or a car. This is extra money to protect you just in case something goes wrong. That way you never have to go into credit card debt again. Then number 3 is you have to develop your investing strategy. And the mistake that a lot of people make is they try to do everything at once. And the best analogy that I can give you is when somebody goes to the gym for the first time, I want to get in shape, it can be extremely overwhelming, because now people will tell you have to do high intensity training. Other people will tell you got to do heavy weight training. Other people will tell you need to do low intensity training. Other people will tell you to get a trainer. And then other people will tell you it's not about the workouts, it's about your diet. Go vegan, go carnivore, go paleo, go keto, whatever it is. And now it's very overwhelming because you have no idea what you should be doing, when in reality, you just got to start. Put down the donuts and ho-hos and walk on a treadmill. Then maybe put the treadmill on an incline. Then maybe pick up some weights. Then you start to see what you like and you start to do what's right for you depending on what your goals are. It's the same thing with investing. There are so many ways to start, and just start, because you're gonna make mistakes. Every video I say that investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The reason why I say that is because number 1, personal finance is personal. What's right for me is not going to be right for you. And number 2, you're going to screw up. It's a part of the process. Every single investor in the world has lost money at some point. The goal is to make more than you lose, but you're not going to be able to make those successful trades and successful investments until you make the screw-ups and learn how you screwed up. So just get started. If you have a 401k, start with your 401k. It's simple. Open up an investing brokerage account and just get started, and then you can start learning about active investing versus passive investing. I teach this a lot on my channel. Passive investing is where you invest your money into funds. funds that give you exposure to the S&P 500, which is the group of the 500 largest companies in the stock market. There are funds that give you exposure to the total stock market. There are funds that give you exposure to real estate stocks. There are funds that give you exposure to AI stocks. There are funds that give you exposure to international stocks. There are funds that give you exposure to dividend stocks. Just get started, and then you'll start to learn how to analyze those funds and how to decide what's a good fund for you. Active investing is not trading. I don't believe in trading. I think that's a way of gambling, and that's a path to lose, because we know statistically the vast majority of traders will lose money over the long term. But when I say active investing, I mean looking for individual companies to invest in that you want to hold for the long term. And by long term, I mean at least a year, if not many years, if not decades. But this is where you want to study what I call market shifts. You want to pay attention to where the economy is moving, where money is moving in the economy. Like we know money is moving into AI. How does that create investment opportunities? We know that President Trump has made a lot of changes in the economy. How does that change investment opportunities? These are called market shifts. And depending on where the money is moving, that can create an investment opportunity for the people that are willing to take on the extra work, extra research, extra time for the additional risk that comes with more potential return. Again, more risk for more potential return, and now you can decide if you want to be more of an active investor or a passive investor or a hybrid of both. And then you can decide, well, maybe stocks are not right for me. Maybe I want to invest in real estate. And then you say, maybe I want to have some more speculative investments like startups or cryptocurrencies. Maybe you want to add some physical gold into the mix. That's how you start to build your investment portfolio, but you don't have to know everything to start. You just got to start. And you don't need a ton of money. Start with $100. Start with $10. Start with what you have. Stay consistent. Don't get caught up with the shiny object syndrome with people on the internet talking about how you can double your money in 6 months. It's a bunch of crap. It's not how it works. That's not how actual investing actually works. We can take a look at people who've been investing their money for decades. We can take a look at investments over the last 100 years. We know that those things that have the shiny object of big returns can build huge returns, and then they also fall oftentimes just as fast. And that's where you'll start to learn. You get burned a few times, but then you learn how to actually invest your money for the long term, but you gotta be willing to keep getting up and coming back. And then number 4, when it comes to you spending money, no more financing things that don't put money in your pocket. Do not finance cars, do not finance your iPhone, even if it's 0% APR. Stop financing your sofa, stop financing those trips to Cancun, stop financing the Gucci, because the reality is these things that don't actually put money in your pocket, when you finance it, now number 1, you are buying something that's losing value, which that's fine. But now not only are you buying something that's losing value, but you're paying interest on something that's losing value. And oftentimes these things have a limited lifespan. So you go out and buy this $50,000 car. Well, when you finance it, you're going to end up paying $75,000 to purchase that $50,000 car plus interest. And then when you go to sell that car 5 years later, you're only going to sell it for $20,000. You bought it for $50,000, you paid $75,000, and you only get $20,000 out. That's not a winning transaction. So when it comes to things that don't put money in your pocket, do not finance it. And then when it comes to the luxury things, because I'm not against you buying nice things, I just want you to be able to afford them. And when I say afford those luxury things, I like to follow the rule of 5, which says if you can't buy 5 of them, you cannot afford 1 of them. Once you understand this, well, now you can break out of the system and start building wealth for yourself, because what we talked about is so many people get stuck. You go out, get a good degree, you get a good job, you pay the highest taxes, and then you just start spending money like everybody else. And you live what I call net zero, which is you make money to spend the money, and now you have to finance the additional expenses that come up, which doesn't seem like a big deal, but they start to add up, and you just keep hoping that if you make some more money, all your financial problems will be solved. But what we've seen statistically is as people get bigger raises, they end up in bigger holes, because now you become more creditworthy, and expenses always keep going up. And so if you want to break out of that, the simplest and best way, not the easiest way, is to pull the Band-Aid and make some extreme sacrifices for a little period of time. If you enjoyed this clip and you want to continue your financial education journey, I have another video that I think you'll love. All you got to do is click that button right over there. And for those of you who want to stay up to date on the top finance and business news, you can join Market Briefs, my free financial newsletter, by clicking that button below. Thank you for watching, and I'll see you in the next one.